Alright, welcome everyone. This is Accounting 202, Chapter 4. And in Chapter 4, we're going to go over process costing. And remember that in Chapter 2, we discussed job order costing. And a couple of the similarities between those two processes is both systems assign both material, labor, and overhead costs to products. And they provide a mechanism for computing the unit product costs. And both systems use the same manufacturing accounts, and that includes the overhead accounts and all the inventory accounts, the raw materials, work in process, and finished goods, and the flow of the cost through those general ledger accounts is virtually the same, with one exception, and we'll get to that in just a bit. Process costing, though, is used when a single product is produced on a continuous basis for a long period of time. Usually it's the same exact unit of production. Things are identical every time. Whereas job order costing is used for customized or individualized orders and products. Now, the job order costing systems compute and accumulate costs by individual jobs, whereas process costings, because everything is homogenized and identical products, process costing computes and accumulate costs by departments, and generally processing departments are portions or areas of the manufacturing facility that performs the same function, and their end product is usually identical, although it may not be a completely finished product. So the activities performed in a processing department are performed uniformly on all units of production, and their output will be homogeneous, although it may not be a finished product. So, learning objective 1 from the chapter discusses recording the flow of materials, labor, and overhead through the process costing system. And it's mostly the same. Remember that generally the flow of materials, labor, and overhead costs all goes into work in process. Those are the additions to the work in process inventory account for a company. Once it's done, then moves into finished goods, and finally, once we sell those goods, it becomes a cost of the goods sold. That's finally when it's expensed. For job order costing, again, this was Chapter 2 stuff. We did it on an individual job basis. We would accumulate or assign the direct materials, the direct labor costs, and then we would assign the manufacturing overhead. In a process cost system, however, we will assign and apply the direct labor cost, the direct materials cost, and manufacturing overhead cost to a department and then move it along the chain. Thought we'd start first with the general ledger accounts just to see how the costs flow through all those inventory and manufacturing accounts. And the example we're going to use is similar to the homework you're going to have, where we're going to assume the company's manufacturing facility has two departments, and we'll call them just Department A and Department B for our purposes today. So when we start using materials, and these are direct materials that are going to be used in production, we take them, of course, we reduce our raw materials inventory, and we increase the work in process account. And for our example, we will have two different work in processes, one for Department A and one for Department B. And that's really the distinguishing factor between this and process costing. Same accounts, but there'll be multiple work in process departments. So we're moving some materials out of raw materials inventory and into the production, which means we take them into the first department's work in process. Next, of course, as we pay our salaries and wages to our direct laborers, we would move those as well into work in process of Department A. And finally, once we have accumulated all the work, the manufacturing overhead, and we're now going to apply it to the work in process, we'd move it from the manufacturing overhead account to the work in process for Department A. And that is, of course, all the additions we would have for work in process for Department A, all of the manufacturing costs that we've incurred during the period. Now, once Department A is done with a certain amount of products, Instead of moving them into finished goods ready for sale, because these products are not ready for sale, they would move them into the next department, which for our purposes is just called Department B. And it's really simply just taking it out of one work in process from Department A, that's crediting it, and then debiting the work in process for Department B to show an increase there. And that's one of the costs for Department B's work in process, right? They need to receive what's been done by Department A, and that's almost like a raw material or a direct material for Department B. And Department B is now going to add to that additional direct materials, additional labor, and some more overhead to finally finish the product. So once Department B is done with their product, of course, it is then finished goods and ready to be sold, so we would be crediting the work in process for Department B and moving it into the finished goods inventory account by debiting that finished goods inventory. And finally, of course, once we sell the goods, nothing new here. Of course, we're going to be crediting our revenue account, which is sales, and debiting the cost of goods sold account for the appropriate amounts, thereby matching our expense with the revenue that the expense itself helped generate. Nothing new there. Costs flow right through to cost of goods sold once they are sold out of our finished goods inventory account. So that's the flow of the cost going through the accounts. But now let's work on how we actually determine the amount of overhead to apply to all of the units of production, and specifically to the departments. So process costing requires computing how many units have been produced by each department during a period. And the problem is, of course, sometimes units are only going to be partially completed by each department. So we need to come up with what's called equivalent units of production. And equivalent units of production are the product of the number of partially completed units and the percentage of completion of those units. What I mean is, the simplest example is we had 2 units that were each halfway completed. Multiply those out and you would have the equivalent of 1 equivalent unit of completion. A little bit more of a complicated example is if we had 10,000 units that were about 70% complete, you just multiply those 2 out and we would have 7,000 equivalent units of production. Now, don't worry, you will never have to determine the percentage of completion. These things will always be given to you, and in the real world they would be provided to you by production managers or the managers of each respective department. You will simply need to know how to come up with the equivalent units of production based on that number. Now, this book does give you both 2 ways to calculate equivalent units for process costing purposes. The first one is the first in, first out method. It's covered in the appendix of the chapter, and don't worry about it. You do not need to learn that. I will not test you on it. There will be no homework assignments on it. If you're interested in learning about it, feel free to read that and shoot me a message, and I'll happily go over it with you. But all we're going to be learning for the purposes of our semester is the second part, the weighted average method, and this is in the main body of the chapter. But the first in, first out method for now, you need not worry about. So, how to compute the equivalent units of production using the weighted average method. Let's jump right into that. Fortunately for us, the weighted average method is the simple method of calculating things. And this is the thing to memorize here, and will likely be the source of much frustration for you during the homework and exam, so commit this to memory and it should help. But the equivalent units of production for a department are the units completed and transferred plus the equivalent units in ending work in process. So in other words, if we completed 100 units and we had about 50 partially completed units, you would want to multiply out the partially completed units by the percentage of completion plus the 100 that we completed. So memorize this, and you'll see it in examples. I think it'll be much more clear, but memorize the fact that equivalent units of production for a department are the number of units completed plus the equivalent units remaining in that department's ending work in process inventory. I want to talk about a little bit of terminology here. Remember that the 3 types of production costs or manufacturing costs are direct labor, direct materials, and manufacturing overhead. Now, because direct labor costs are usually small in comparison to other product costs in a process costing system, again, because of mostly automation. When things are identical, they will be mostly mechanical and automated production, and direct labor will make up a very small part of the production costs. Because they are often treated together to make costing a little more simple. And what we will have is then, once you combine labor costs with other overhead costs, we call that conversion. And the reason is because we're taking our materials, right, the direct materials, and everything else, the labor and all the other overhead costs, is basically converting those materials to something greater, to what it is we are going to sell it. So we're taking raw materials and turning them into a finished product, or converting them. And we're going to refer to both manufacturing overhead and labor costs combined as conversion costs. This was reviewed in Chapter 1 a bit. We didn't go much into it in detail, but it is in the chapter if you do need to review, but I think this will suffice. And this concludes Part 1. We'll pick up with an example information on Part 2.